fundsupermart.com.
Hello everyone. With us today is Alexis Gray, Economist of Investment Strategy Group, Vanguard Investments, to give us an update on the outlook of developed markets and share with us her investment philosophy. Hi Alexis, thanks for joining us. Recently, we saw the S&P 500 scoring new record highs in intraday trading to erase earlier losses. What are the drivers behind the rally? Does it imply that the U.S. economy is on track towards a sustainable upward trend?
I certainly think that the rally that we've seen in the US equity market reflects growing optimism about the US economic outlook. And I think it's been reflecting that for several years now. So if you look back as the economic recovery has progressed, we've seen the equity market rally on that news. And generally at Vanguard, the way we think about the outlook for the equity market is that consensus forecasts for the economy are already priced in today. And how the economy performs relative to that consensus is really what drives the market. So when we see forecasts upgraded, typically the market rallies, and when forecasts are downgraded, typically the market underperforms. But for 2014 at Vanguard, we believe that the risks to the economic outlook for the first time in many years are actually tilted to the upside for a couple of reasons. The first is that in the last few years, businesses and consumers have been paying down debt. And so we're probably past the worst in that deleveraging cycle, and so there is some pent-up demand which could be unleashed this year, which could boost growth. And the other factor is the government balance sheet this year is likely to be more accommodative. So I think that the US government has acknowledged that they need to provide support to the economy, and so that will help boost the economy. In terms of what this means for the equity market outlook, I mean, when you look over the last few years, valuations have been rising on this optimism. And if anything, they're looking a little bit stretched at the moment. So we would caution investors against chasing that past performance because the outlook is probably already priced in. And looking forward, we may expect, in fact, that the equity market underperforms relative to its historical trend, but still provides quite good growth.
Europe's economy finally exited recession last year, but the recovery seems fragile at best. Where do you find investment opportunities in this space?
I think there are investment opportunities really across Europe. In the last few years, there's been a sense of uncertainty about the outlook for Europe, particularly because of sluggish growth and the possibility of the Eurozone breaking up. And this is really reflected in the equity market with low valuations, so they're relatively cheap. Now, history tells us that there is an inverse relationship between market valuations and forward-looking returns. So basically, when valuations are below the historical average, we can expect to see the equity market outperform history over the next 5 to 10 years. And thinking back to the economic outlook, certainly last year was a positive year for the European economy. They exited a recession for the second time in 5 years, but fundamentals are still quite poor. So we see positive growth, but only low positive growth, around 1% GDP growth, and unemployment is still around 12%. So the outlook is not extremely positive compared to other parts of the world. It's also really a tale of two halves, where some of the core economies are much stronger than the periphery, like Greece and Spain, where the banking system is still very unhealthy. And so there are some real imbalances within Europe which policymakers are trying to address at the moment. So although we see some optimism in Europe, the outlook is still not as positive as elsewhere in the world, and this is reflected in the market. In terms of investment opportunities, what I would say is, although equity market valuations are a little on the low side, that's because of the risks to the outlook. And so what would we advise clients to do is to invest across Europe in a more broadly diversified way rather than trying to pick one market over another.
Japan is one of the best performing markets last year. In your opinion, will the Abenomics continue to work well and support market performance this year?
I think the short answer is that Abenomics won't be as effective this year as it was last year. In the initial announcement, there were three parts to that policy for Abenomics. One was that government spending increased last year, and that already had the impact of boosting economic activity. But this year, the government is now focused on trying to improve the balance sheet, and so we won't see as much spending. And so in that sense, Abenomics won't be as effective. In the second policy, the Bank of Japan implemented quantitative easing, and this boosted inflation for the year. But what history tells us is that that quantitative easing tends to have a diminishing effect over time. As an example of this, in the United States, the Federal Reserve is now winding back quantitative easing because they don't see that it's as beneficial as it was originally when it was implemented. The third part of Abenomics, which is important, is structural reforms that the Abe government hopes to implement. Now, they've signalled some reforms around the labour market and deregulation in other sectors of the economy, and depending on how they implement these and how effective it is, this will be the key to the long-run success of Abenomics. In terms of the outlook for the equity market, I think last year was an incredible year because of this positive surprise to the economy. However, this year I think we can't expect to see that same repeat of the equity market performance. Looking out even further, when you consider what is the best predictor of future equity market returns, it's the valuation in the market today. Now, valuations are looking a little softer than they did quite a few years ago, in fact. So Japanese equities are looking cheaper than we saw, say, 5 years ago. They're more in line with US valuations, which points to us to future returns which are around trend or slightly below trend.
Could you share with us your positioning strategy? What asset classes do you prefer?
So at Vanguard, we have I think a different approach to investment strategy than some of our competitors. So we would advise our clients to tune out the short-term noise in the market, not to try and select one asset class or one sector over another, but instead to take a step back and consider their long-term investment goals and their risk preferences, and to set a strategic asset allocation, basically, which means that choose your asset allocation and stick with it. And so there is a role for different asset classes. For equities and property as risky assets, which tend to provide growth to a portfolio, but also for defensive assets like fixed income and cash, which can provide a diversification against those risky assets. And typically when the equity market is down, we see cash and fixed income holding their value, which is a really important property. Even when rates are low or rates are rising, we still tend to see bonds holding their value, which is really important. So taking this all together, we believe in implementing a strategic asset allocation using low-cost investments.